Hello and welcome to the Africa Hour, the show where we dedicate time and expertise to one policy issue in one African country, looking at it from different perspectives. I am Olumide Abimbola. This season, we are focusing on the growing tech ecosystem in Africa. Today, we're in Kenya, where a certain subset of fintechs are facing serious allegations of misconduct and calls for harsher regulation by the country's central bank. As internet penetration has deepened in the East African country, fintechs have sprung up. Among them are digital lending companies that allow people to get money with very little hassle. About 120 of these companies currently operate in Kenya, and they have boosted the numbers of people who have access to financial services by about 50%. That's good, right? Well, the problem is some of the digital lenders are allegedly engaging in unethical practices. The result is that people are getting trapped in debt. About 50% of borrowers have defaulted on their digital loan repayments in Kenya. That is according to the central bank. Plus, research organizations as well as law firms in Kenya have found that some of these companies mine their customers' data without consent and use that information in very questionable ways. So I want to know, why are some of Kenya's lending apps able to operate in such a manner? And more importantly, how can their activities be better regulated under the law? As usual, I talk to the people who know way more about this than I do. That's after the break. So, what is going on with Kenya's digital lending apps, and how can the issues plaguing the industry be solved with effective policies? I am talking to Kevin Mutiso, chairman of the Digital Financial Services Association of Kenya. Kevin, welcome to the Africa Hour.
Thanks for having me. It's a real pleasure and honor.
I also have two lawyers with me, Cynthia Mutete and Ariana Issaias, who are both seasoned advisors specializing in financial technology with Bowmans, a Nairobi-based law firm. Welcome, Cynthia. Welcome, Ariana.
Thank you. Really excited to be joining this discussion today.
Happy to be here.
And finally, Carlos Mureithi, a journalist covering tech in Kenya and currently Africa correspondent with the Christian Science Monitor. Thanks for joining me, Carlos.
Thank you for having me.
So I want to start with you, Carlos. You've done some reporting on digital lending apps for international media platforms. I want you to please help us set the scene by telling me what people told you in the course of your reporting. I want to know what you've seen and experienced yourself. Maybe you can also help us understand what a mobile loan is. What is the loan granting process? What usually happens when people default? Give us a general view of what this is in Kenya.
A mobile loan or a digital loan is a loan that people can get through their mobile phones, through apps. You can get it through USSD, or you can download an app and get the loan. And these loans are quite convenient for people to get because you just need to download the app, read the terms, accept them, and in minutes you get the money that you need. So the lending company or the app behind this will assess your mobile money transactions, and kind of assess how much you transact with, how much is flowing through your mobile phone, and they'll be able to gauge how much they can lend you. And they usually do this pretty quickly, within just a press of a button, and you conveniently and easily get the loan. This is in contrast with a traditional lender like a bank, for example, whereby you would have to fill in forms, maybe perhaps take security to the bank, and it becomes, a process that can take days before you get the loan. So that's what a mobile loan is.
Mm-hmm.
So most people have access to mobile phones in Kenya, and that makes it so much easy and convenient for them to use these loans instead of going to banks and other more formal institutions. But then what happens is, from what I've known from my reporting, the stories people have told me, many people borrow these loans for basic things at home, household items, or just to buy airtime for your phone, or sometimes even for emergencies. So they're little loans, you get them easily, you use them.
Right.
But then some of the problems include that they have high interest rates, so they're kind of predatory and Shylock in nature. And people with time, they are unable to pay back. You end up borrowing from another lending company to pay the original lending company, and you get into a debt cycle. You fail to pay back one of the loans. You get blacklisted on a national credit reference bureau, and you can't borrow again. And sometimes you just borrowed $10 or less, so you have people blacklisted. Yes, these loans are helping people, low-income earning people, to access credit, but then also the way they are set up, it also kind of eventually locks them from getting future credit.
That is interesting. I mean, it's financial inclusion in the sense that people can actually have access to credit, but it also appears to have negative implications. Can you tell us a bit more about the experiences of people that you've spoken with in the course of your reporting? Can you give us a sense of what it feels like to be a person who has taken such a loan?
I've spoken to people who've been unable to pay back these loans. Many of them were taking them maybe to fund their small businesses, maybe their small retail shops, to fund them for their day-to-day work. But then eventually they are unable to pay back, and it becomes difficult to continue to sustain these small businesses of theirs because they get blacklisted, they're unable to borrow again. So it puts them in a really tight financial dilemma. And once they are unable to pay, many of them say these lending companies use quite unethical debt collection practices. They are quite aggressive in how they try to recover their money.
Could you tell us a bit about the processes that they've used?
Yes, so they tend to resort to, many of them, I would say, not all of them, but many of them tend to resort to threats, threatening the person who has not paid back the money. If you don't pay back, this will happen to you. We will contact people in your phone book. Remember, at the start, when you're registering to use these apps, they have access to your phone.
Okay, that's a lot.
Yes, the app has access to information on your phone. And you sometimes also have to write the name of a reference person or someone they can contact in case you default. But many times they just contact anybody in your phone book. And they shame you. We call it debt shaming. So they tell people, your circle, people you work with, your family members, they send them messages, they keep calling them, telling them, Tom here hasn't paid us $20. We still owe him money plus interest, and if he doesn't pay, we'll keep calling you 20 times a day. Even if you don't answer this number, we will use another number to call you. So the people who didn't pay back the money are kind of, they're put into this debt shaming, and also innocent people who are not part of this. They didn't give their numbers to these lending companies, but they also face some victimization in a way.
Right.
So that's data privacy, I would say, in a sense, because they're collecting data from your phone without your permission. They're getting other people's contact details and calling them and sending them messages, threatening them. So there are a lot of negative sides to this.
I just wanted to come in and wonder whether you didn't give them permission to that, actually, because we all agree to certain things when we sign up to things without reading them. I think this is a question for the lawyers. Ariana and Cynthia, you are both lawyers with a lot of experience in this sector. I want you to first help us understand the general regulatory environment for digital lending apps in Kenya. Maybe I start with you, Cynthia. How are digital lending apps being regulated under Kenyan law in general?
So digital credit business is now regulated by the Central Bank of Kenya and digital credit regulations. Now, these regulations came in effect in December 2021, and they became operational in March 2022. So the directive from the Central Bank of Kenya was that if you are an existing player as at December 2021, you can continue to operate your business, but you need to submit your license application to the CBK in September 2022. But if you are a new player in the market, you need to not commence business until you get the license. So as you can see, the regulations are relatively new. They're
Right.
just coming in, and the CBK has received multiple applications, and we understand that they've licensed around 21 or 22 digital credit providers so far, and they're still licensing others in the market.
Ariana, I think you wanted to come in.
Just to add, I think that the regulations that Cynthia just highlighted, they are also supplementary to some of the existing regulations which we already have. And I mean, primarily we have strong consumer protection regulations, which are strongly and strictly enforced. You've already touched upon data, but we have a Data Protection Act that was introduced in 2019. And we also have anti-money laundering regs, which are also very strongly enforced. So it's really a kind of a myriad and framework of different pieces of legislation, which, as Cynthia said, it is new. So I think it takes some time, I suppose, to try and see some teeth.
I want to also understand the different kinds of companies that provide the mobile lending services. I don't think they're all the same. Maybe you can guide us through the different kind of companies that exist and the kinds of regulations that apply to them.
So lending generally in Kenya has not been regulated for a long time. We just had now the digital credit regulations coming in 2021. But there are different lending products in the market. So you would have, for instance, the mobile lenders, you'd have people who provide factoring services, and you'd have people who provide asset financing. There's just many other lending businesses. But the focus here, even from the inspiration of the regulation, has been mobile lending. So most of the companies who are affected by the concerns that Carlos just spoke about, mobile lenders or digital lenders who provide the kind of loans that Carlos was referring to. And when the regulations, when they came into place, as they were created after these concerns had been raised to the regulators and the members of parliament, they've really been drafted towards addressing those specific concerns. So, for instance, there are heavy consumer protection provisions. For instance, there are restrictions against reckless lending, which is what you had referred to earlier about just lending to people who can't pay, but then they just keep accumulating debt and then the interest just keeps going higher. So there are restrictions against reckless lending. There are regulations about pricing. So the central bank here doesn't set out rates or caps, but it just requires lenders to submit their pricing parameters to the CBK. And then the CBK sort of approves this. But then if you change these pricing parameters, you also need to get the CBK to approve them as well. There are also provisions about debt collection, the issues that Carlos also mentioned about threats, insults, calling relatives and friends and all that. There are specific restrictions against those. And then I think maybe Ariana can chip in here on data protection provision. So the digital lenders are required to comply with the Data Protection Act, which now I think Ariana can maybe say something more about it.
Yeah, I think certainly, and it's interesting, when Cynthia's going through all the kind of remedies that the new legislation is trying to fix, there's certainly what Carlos was pointing at, what was being faced by the everyday consumer and user of mobile loans. And perhaps, it's a good sign that the CBK was listening, and really the new legislation is reactive, I guess, and trying to remedy that ill. But particularly kind of on data protection. And it's interesting that the central bank is working really closely with the Data Protection Commissioner in trying to flesh out a lot of discrepancies in bad data protection practices. So it's a very strong theme in the new legislation, and something that's enforced by both the regulators, which is great to see the regulators working together.
Thank you, Cynthia and Ariana. Kevin, you are the chairman of the board of Digital Financial Services Association of Kenya, and your body represents these apps. There must be some positive experiences, but there are also several allegations against the companies that your body represents. How true are these allegations, and could you maybe talk about them in general?
Thank you for that, Olumide. It is a mouthful, Digital Financial Services Association of Kenya. I don't blame you.
Thank you.
We were formerly known as the Digital Lenders Association, and the reason we changed our name was just in line with the new regulations that came into place. We did realize that digital lending had gotten this very negative tag in the market, and as a result, engaging with the stakeholders when you're called digital lending, something was becoming more and more difficult. So we changed our name. So we prefer calling ourselves DIFSAC for short. So just for reference moving forward, you could use DIFSAC. DIFSAC, exactly. Now, DIFSAC was formed in 2018 by 7 lenders at the time. And the reason we did that was there was a regulation that was coming into play to regulate the industry, and we felt that the bodies that existed at the time did not fully understand the needs and the wants of the digital lenders at the time. The negative perception had been created, and as a result, we were being perceived as Shylocks, consumer protection cheaters, and data privacy miners. So we're basically breaking all these different laws. The truth, however, is that two things were happening. First, and I think this is why I can give context, is in 1992, and the lawyers could confirm this, the Money Lenders Act was repealed.
Okay.
And as a result of that, we were left with two sort of main industries in lending. You had the regulated entity, which was the banks,
Okay.
and then everyone else that did not take deposits.
Okay.
And then come 2004, and now we have a Microfinance Act that now creates this new entity called the Microfinance Bank that can collect deposits, but has different regulations compared to the banking system.
Right.
Within that 2004 Act existed the opportunity to have a non-deposit taking microfinance institution, NDTM.
Okay.
What we tried to do at the time in 2018 was to try and sort of activate the clause that allowed for these institutions to be regulated and to get the central bank or whatever entity that was going to regulate us moving forward to do so. Now, again, more context. So in 2004, this act comes into place. Of course, they don't take into consideration the non-deposit taking microfinance institutions. And for the simple reason is that we were small. We were less than a single percentage of total lending in the market, and the government just didn't see a reason why they should regulate us.
Right.
Come 2007, you now have M-Pesa. Come 2011, you've got the first digital loan app or digital loan product through the banking ecosystem. So a bank-led product called Mshwari.
Right.
That spurs a lot of excitement in the ecosystem. So we've got foreign investors who want to come in. And by 2014, we've got the first two non-bank-led digital lending products. And by 2016, we were about 10. And that's when I came into the industry with my own app. I was the first indigenous Kenyan to launch a digital first lending product. And then come to 2018, we're now at about 100. And fast forward to 2023, we're now over 400. So the growth in the sector was crazy, as you can imagine.
It sounds exactly like that. That's amazing.
Yeah, it's been exciting. So by 2016, we were serving about 4 million customers. Now we're serving over 10 million customers. In 2011, we were serving 0 customers. So just for context about growth and why the regulation was now more necessary now than then. So 2018 comes along, and this bill called the Financial Markets Conduct Bill comes into play. The idea with that bill was to create a financial conduct authority similar to that in the UK. The central bank at the time didn't feel that that was necessary, and so shut it down. 2020 hits, and this is another contextual piece. We're finally making money. So the other context is digital lenders, unregulated digital lenders hadn't been making money for the last 4 years because we are algorithm driven. So a lot of the credit scoring we use is based off algorithms we build, and how to build an effective algorithm is by sort of putting in data and then having that data continuously stream into a system, and then it becomes very predictive over time. So by 2020, early 2020, we were making money. COVID hit, March 2020, and something very substantial happened here.
Okay.
The central bank governor then took away the rights of unregulated lenders to submit data to the Credit Reference Bureau. The idea here was the COVID pandemic was going to affect the majority of our client base, which is bottom of the pyramid. And the idea was, can we, as government, protect them from losing the credit scores and the credit profiles they had built by that point, so that they can then, once things sort of settle, they can then continue. It was a bad idea. They did not have any kind of stakeholder engagement because there's a misunderstanding, and Carlos alluded to it, of what a credit reference bureau is. A credit reference bureau isn't a blacklist. A credit reference bureau is basically a record of your data, of your credit habit. So if you borrow and repay on time, the credit bureau captures that.
It's basically like credit ratings in the US, for example.
Well, similar to that, but it's a bureau.
Right, so done by a bureau, yes.
Yes, so it's basically Olumide's credit habit. Does he pay on time? Does he pay late? Does he
Right.
default?
Right.
Right. So that misunderstanding at that high level in government caused us to be kicked out of the ability to report into the credit bureau. And in fact, 3 months later, all the data from unregulated lenders was then expunged.
Okay.
Right. So it was deleted in whole. And that affected over 3 million people. But that's part of the story, as I'm getting to my point.
I'm waiting for you.
So as a result of that, we as the association ramped up our lobbying process because now we were sort of under attack. And of course, we needed to get the stakeholders to understand our problem statements very well. So fortunately, an MP, a member of parliament, then put in place a bill that was going to be a CBK Amendment Act, so Central Bank Amendment Act, that was then going to provide for regulation for digital credit providers, which is what the legal team spoke about.
Right.
So up to that point, as I told you, there's been a lot of growth. And so what had happened because of the growth, you had two sides of the market. You had mission-driven fintechs that were trying to solve for the access question,
right,
access to finance question. And then you had the opportunists who had capital that they wanted to get a return on and used very rogue tactics to acquire market share and, of course, to lend. And so today we've spoken about two major ills. The first ill is the harassment of customers by debt collectors. So what we've been able to do is the largest perpetrator of that act has now left the market.
Okay.
Right. So in 2021, as a result of our efforts, that business left. And now we have seen a serious decline in that type of behavior. And it has come down to near zero since the regulation took effect. The second big ill that's usually when we're being accused of something is over-indebtedness. So yes, over-indebtedness is a huge issue in this market, but that's a systemic issue. It's caused by data silos that have been created by the central bank and other stakeholders within government because they don't understand how data flows between the different parties. As a result, and just for context again, the largest digital lender in Kenya is actually a bank. Right? So what happens is because the largest digital lender can access the credit bureau and then the unregulated lenders can't access the credit bureau, we end up lending to this, chasing the same good customer. We end up giving that customer money. And so, and I'll give you an example. If my system says Olumide can accept 50,000 shillings and the bank system accepts, sort of calculates that you can get 50,000 shillings and we give you 100,000 shillings, we have over-indebted you without knowing that we have.
Right.
And so that's what's causing that problem of over-indebtedness more than anything.
I can see where you're going, but I still want to ask a question about your business model. What is the business model of your company, for example?
So the company I run is a company called Oye, and what we figured out is how to lend to a specific demographic known as the motor taxi riders. In Kenya, we call them boda bodas. In Nigeria, I think you call them Koko.
Okada.
Okada, exactly. We've got 2.4 million riders. They earn about $20 a day. They have a very different trading cycle to the average business. So what we've done is we've designed products specifically for their trading cycles.
Okay.
So we do buy now, pay later for smartphones, and they pay us a daily rate instead of paying us weekly or monthly. And so to answer your question about business models, the innovation we brought to the table into this ecosystem is we went to the base of the pyramid, understood those unique trading cycles, 1 day, 7 day, 15 day, 21 day, and adapted products that fit that market.
Right.
And that's actually the main innovation.
You mentioned a company that you essentially chased out of the market. Can you speak about them? Because if they are the one that is the culprit here, maybe we should hear about them.
So my team always tells me for PR purposes, it's not wise to say the name of the business, but it started with an O and ended with cash. right? So that business basically, I don't use the word pioneer, but were the first to harass customers by calling contacts, sending them threatening messages, and it was a very effective tool. And what happened then after that is other companies that didn't have the mission-led approach started using that same type of debt collection practice to collect money from customers. And so in 2020, when we ramped up the lobbying and the stakeholder engagement process, one of the key things we did was to ensure that we let stakeholders know that we were not for the debt collection practices that business was using. And so we set up a code of conduct that explicitly said that if you want to be part of our membership, you could not do that. We set up a complaints mechanism within our ecosystem, and we would collate all those complaints and send them to the central bank and the office of the data commissioner. And so what happened over time is that the complaints were coming from one business.
Right.
And so the writing was on the wall. If they wanted to get a license in this market, they were going to have a tough time because they were known as the main perpetrator of this horrible practice.
Carlos, has the system of harassment changed with that company out of business?
The company was it was one of the main examples that victims that I would speak with would mention that they borrowed from. And their tactics seemed a little more extreme than the others. So it kind of set the example or set the tone, and then after some time, other companies started copying their model.
Doing the same thing.
Yeah, they thought it was more effective to harass people and recover your money.
Yeah. So has it stopped now?
It hasn't stopped.
Okay.
It has gone down, but it hasn't. There are still some shady companies with shady practices.
There's only one company left, by the way, that's doing it. Ends with Path. And that particular company will also be driven out of the market in no time.
Before we go on with the conversation, as usual, we go to the streets, and we went to the streets of Nairobi to hear from people what their experiences with digital lending apps have been. Listen to Robert, Ferian, and Steve.
My name is Robert Ouko Maunga. I'm an Uber driver. I've been doing this work for the last 3 years. Now, you asked me about the digital lending apps. I'm actually on most of them. I've taken loans from like 3 to 4 platforms. There's Zenka, there's Tala. And the good thing about these apps is you get the loans without any security. You see the way banks do it, you go to the bank, you have to give them a security. It could be your payslip. But now the apps are free to use in such a manner that you don't need anything. You don't need to give them anything. It's just fill in your details and the loan is processed. So they've always come in handy. The only problem is whenever I take the loans, it's never to invest in any other business. I could be short on fuel, I could be short on airtime, I could be short on any other thing. So paying them back becomes hard because it's not money that I've invested anywhere. So I've had issues, and that's why I've taken loans from the many platforms that I've mentioned. It's because I don't get the chance or the discipline to clear one loan and ask for another one.
Hi, my name is Ferian and I own a business. I make crochet outfits at Crochet 254 and I also make scented candles. Well, I do not have one. I have used one before, but then I have people that are very close to me that use them. So my experience, based on the effect that it has had on me from the people that are close to me that use it, is really terrifying. First of all, when they give people the loans, they do not ask you to guarantee them. But then when they default, they call you, threatening you, sending you messages every now and then, unnecessary insults, without really knowing that you were not the one that guaranteed that loan at will. Yeah, so it's really unfair to people. I feel like those people are just thieves, to be honest. They steal from people because they impose a lot of interest that's not necessary, to be honest, and they force people that are not directly their clients, they threaten us. So even if I wanted to borrow from them, I really can't because I know the experience.
My name is Steve. I work at Kenyatta Hospital as a casual. I have dealt with money lending companies, rather I've used them, specifically Tala. I would confidently say that for an average person, they really come through and they give us some money whenever you need. They will lend you some money and then you'll refund it. One thing that I notice is that their rates are kind of high. The amount that you're supposed to pay back is kind of high. If maybe they would consider the percentage, then it would be convenient to us.
That was Robert, Ferian, and Steve speaking in from Nairobi about their experiences with the lending apps. And on the constructive note that Steve ended on, speaking on things that can be done better, I also want to continue along those lines by turning first to the lawyers. We heard earlier the case of a company that was, according to Kevin, kicked out of the market. So Cynthia, has that company or any other one been brought to some sort of justice?
So far as we're aware, we have not heard of any cases that have been brought against them, especially now following the enactment of the regulations, because now some of them are still obtaining licenses. Some of them who are not intending to be licensed and be subject to the regulation have now just left the market because they did not submit the license within time. So we're not aware of any specific cases against any of these lenders brought in a court of law. But as Carlos has said, it's just the customers have been complaining a lot, and that's what actually influenced the development of the regulation. So I think a lot of it has been concerns from customers that are brought to the regulators and parliament, and then they take action by passing the regulations. I think because the regulations are fairly new, CBK is still at the beginning of licensing the entities. We're just waiting to see how the implementation will go ahead, how CBK is going to crack down on non-compliant digital credit providers in the coming days.
Ariana, would you like to add to that?
I would say, kind of banking the unbanked has been the biggest and the best challenge, for a lot of kind of financial technology service solutions. Kevin highlighted his platform offering, and I think that ingenuity that we've been seeing has been there to help, as I said, bank the unbanked. I think the desperation which the Uber driver kind of highlighted, he's got 4 rolling, and those are just to make ends meet. And, to a sense, it's driven, and the need to have 4 or 5, not really understanding the terms and conditions, not really understanding, what the repayment requirements are, just come from, the pure, simple need for survival, month on month, or not even month on month, day to day or week to week. I think one of the benefits that we will see with the new regs is that there will be increased transparency. So once you have been approved, right, they will be published on the CBK's website. And, I think there's only 19 or 22, okay, as of January that have been approved. It's a big backlog, but, as Kevin also mentioned, there are a soaring number and an increased number of digital credit providers that the CBK is considering. But, once they get through that churn, once they get through all the applicants, they will be registered, they will be listed. And, somebody who does legitimately, need a loan will be able to look on the CBK's website and say, okay, great, these guys have been vetted, these guys haven't been approved. I know I'll be safe to an extent, when I take out a loan with them.
Over to you, Kevin. You heard the complaints that the people we talked to have, and I think the chief of them is the interest issue. What role is your association playing around that? Is there any way that can be regulated in a sense before waiting for the government's regulation to come in place?
So first of all, Tala and Zenka are my members, and I'm very proud that both of the customers that use the platform said that it was very relevant for them. What I want everyone to note, especially those listening, is that the second person had never taken any of these products, but had the most negative view on them. And that, for context, is part of the problem when we're having this conversation, is a lot of the people who don't use the product are the loudest in terms of the negative aspects, and they sort of drown out all the good stuff. In terms of pricing, so pricing is a big issue, and we do acknowledge that the prices are a bit high. But because we've not had a stable marketplace in Kenya around digital credit, it's very difficult to reduce prices without some stability. So I'll just highlight two issues. The first issue is that because of all the negative stuff, it's very difficult to raise money in shilling for unregulated lenders. And so we end up having to go and borrow money in dollars or in hard currency. And if you know anything about the African currencies and the depreciation against the dollar, you know that if we're borrowing in dollar and having to pay in dollar, there's a lot of hedging that then must take place. And so we end up borrowing net at almost 30% per annum. So our wholesale capital is already very expensive, right? So that's problem one. And then, of course, you've got the depreciation of the shilling against the dollar, which then further adds to the pricing issue. The second thing that causes the pricing is an inability to plan into the future due to the tax regimes here in Kenya. And I think this is not just a digital credit provider problem, it's a problem across many industries. We don't have predictability. Last year, June, we woke up and we had a new 20% excise tax on our products. No stakeholder engagement. When we went to speak to the relevant authorities, they were, we need money as a government, so we don't care, you guys go figure it out. We wake up one morning, we're allowed into the Credit Reference Bureau. The next morning, we're not allowed into the next credit bureau. The other day, you wake up, you're told 2,000 shilling loans and below shouldn't be on. There's just a lot of unpredictability, and you have to price for that in this market.
Right.
Have we made it clear to the authorities that this is a problem? We have, and we're trying. And part of the thing that we're doing is that once we get regulated, we are all going to the shilling markets to then reduce our cost of funding. In terms of regulating price, I'm a free market capitalist. And so I'm a card-carrying capitalist, and I'm unashamedly so. I think anyone who tries to control price in any game is basically going to kill that game in the long run. So let the price settle, let market forces determine price. Regulation should never determine price.
What kind of default rates are we looking at here? People wouldn't be talking about it if things appear to work as well as you've described it. I can understand the point of view of the industry, but I'm also still wondering what this means for those borrowing the money because of how easy it is for them to access it.
Yeah, fair question. So you've asked me about NPLs, non-performing. So I'll give you a product called Fuliza. Fuliza is an overdraft facility that should be paid within the day.
Okay.
I think probably the most innovative and probably the most profitable product in financial services in Kenya today. After 90 days, only 2% of loans is outstanding, right? So very low default rate. For the established players like Tala and Zenka, that number is closer to between 5 and 8%.
Okay.
The reason is simple. Those products have reached maturation. And so you've got a good client base of good customers. You've got that solid base of good customers who take, and so Fuliza does about 1 billion shillings a day, which is about $10 million a day. And then Tala and Zenka do maybe $1 million, $2 million a day in disbursements.
Okay.
So just for context, they've got stable customer bases.
Right.
Now, for the entry-level businesses, the numbers there are different because you're acquiring new customers. Your algorithm isn't well mature. You probably also are attracting a very desperate group of customers. This is because those established businesses already cater so well to the good customers. They don't need new products. And so the numbers there are closer to 50%. And the idea is that you're working towards reducing that NPL to closer to 10.
Okay. Carlos, does this conform to what you've heard from the people you've spoken with?
I think Kevin has some, definitely, since he directly works with the companies themselves, he has some data that it's not publicly available on the default rates. But the numbers we are seeing, I think there was a time the government talked last year and said about 4 million Kenyans who had been put on the bad books of the Credit Reference Bureau because of failing to repay their loans. And that to me sounded like a really high number, considering we are a country of 53 million people.
I'm also wondering, what would the people you've spoken with, what would you expect the service providers, Kevin's members, for example, to do?
They would want reasonable interest rates. That's one of their main desires, the people I've spoken with. And also they would want this kind of, I would call, harassment to end. Once you default, if the lending companies can use appropriate and professional ways of trying to recover their money, and decent and humanizing ways, instead of harassing and threatening people.
Just to add to Carlos's comment on the harassment, and completely agreed, and actually the regs have provision restricting and prohibiting that sort of behavior. So hopefully it will take some time, unfortunately, but it's certainly something that's restricted and, as I said, prohibited under the new legislation. And they're required to make sure that their employees don't do so, and agents acting on their behalf.
I hear you, Ariana, but when are we going to start seeing real results? Cynthia, how quickly would these laws be applied?
The regulations are effective even as we speak.
Right.
It's just, I think it may just be a matter of now getting data of how, just post-regulation, what is the customer experience. And that's something that we may not have visibility on right now, but it's something that we expect, since it's effective and the CBK is already licensing entities and now they're required to comply with those provisions. It's something that should actually be happening even right now. And for those ones who have not submitted the applications for licensing, then should not be operating. So it's, by law, it's effective. It's just practicality implementation of it. But also, we're just looking at the CBK currently has a backlog of applications. So maybe their focus now may be to clear up the applications. And then once the applications are clear, they would do more market oversight or market supervision. But this is just a practical consideration.
We can do a 12-month anniversary interview, Olumide. Catch up in 12 months and see what the market's like.
Okay.
Yeah, but also Kevin can speak to this. Maybe Kevin, have any of your members received any enforcement action from the CBK under these new regulations?
No, the answer is no, because we follow rules and we're following the regulations to the letter.
Of course you do. But I mean, you also know others in the market who don't follow rules. Have enforcement actions been taken against those? Especially the one you mentioned, whose name you didn't want to mention, but whose ending of the name you mentioned.
The lawyers have put it correctly that CBK is going through a backlog. And so what the CBK currently has is very good evidence on the perpetrators of the sort of the bad habits. And the simple thing they will do is not issue them with a license. So they don't really need to go through any disciplinary action as of now, because only 22 licenses have been issued.
Right.
There is a list, however, that came from the Office of the Data Commissioner investigating data privacy breaches. 2 of our members were on that list, have gone through the audit and have passed with flying colors, because, again, we follow the regulation to the letter and we're mission-driven fintechs.
Thank you, Kevin. Does anyone else have anything they'd like to add? Okay, go ahead, Carlos.
Yeah, I think it's also worth pointing out that Google itself, because most of these apps are found on the Google Play Store.
Mm-hmm.
So on the 31st of January, Google kind of toughened its screening process for these digital lending companies. So now in Nigeria and Kenya, it requires these apps to have approval from local regulators. For example, in Kenya, that would be the central bank. So I think that is also an important step in regulating.
Kevin?
Well, I just wanted to say that the government of Kenya, as part of the campaign promises, just validated the beauty and the power of digital lending when they launched a product known as the Hustler Fund. And this product works exactly like our products do. And we've been shouting from the beginning that digital lending could be the greatest invention ever in terms of access to finance. Because what it does is that it's able to do KYC verification, credit scoring, and disbursement at fractions of the cost at what it cost, 5 years ago. And their product has already hit or impacted 6 million Kenyans positively. And from the last report, they said about 1 million Kenyans hadn't repaid those loans. So I think it's important just to note that despite all the negative publicity we get, even the government of Kenya has validated the power of our products very well.
Cynthia?
I think for us as lawyers, we're just excited to see how the regulations are going to be implemented, the impact of the regulations in the market, not just for the consumers, but also for the players, because as I think even Kevin would agree, being regulated and having that tag may have a positive impact on this negative reputation that they have, because now when you're regulated by the CBK and there's no enforcement action against you, then you are secluded from the other entities that are not compliant. So we are very excited to see how this is going to work out, and we're actually hoping that it works out for the best for both the lenders and the customers as well.
And the final word from you, Ariana.
I would say, I think it's an unenviable task, I think, for the CBK and the CMA, which is the Capital Markets Authority. I think regulating in this space, I think Kenya has really branded itself as the hub of innovation. And I think catching up for any regulator in any jurisdiction is no small task. So, it's not a surprise that there's a backlog, but, it's great that we had all those applications and there is that commitment to being regulated. And maybe there just needs to be some better PR in the sector, just to fly the flag of those that are complying and being fair, I suppose.
Carlos Mureithi, Kevin Mutiso, Ariana Issaias, and Cynthia Mutete, thank you very much.
Pleasure to meet everyone.
Thanks, Carlos. Thank you.
Okay, bye.
Bye.
So here's what I've learned in this conversation. I've learned that digital lending companies in Kenya are a double-edged sword. As Kevin and those we spoke to in Nairobi say, the easy mobile loans they provide are helpful for many people. But the negative reputation these companies have right now exists for a valid reason. The industry has exploited customers, and their severely high interest rates trap people in debt. But fortunately, those gaps are being worked on. This leads to my second takeaway. The Kenyan government is very actively taking people's complaints into account and working to regulate companies that provide mobile lending. This stands out strongly to me. There's not only a new law targeting digital lending specifically, but there's also a new licensing process that can filter out the really bad companies for good. That is commendable. Finally, I learned from Carlos, the journalist, that people still want to see improvements from the digital lending operators, despite all the steps the government and the Digital Lending Association have taken. The biggest areas people want improvement in remain those very high interest rates and the harassment from the lenders when people fail to repay the loans, although that part seems to be on the decline. Thanks for listening. If you'd like to learn more about digital lending applications in the Kenyan fintech sector, we've listed some of the most interesting articles and papers we've found on our website, afripoly.org/podcasts. The Africa Hour is brought to you by APRI, Africa Policy Research Institute, and is produced by Bear Radio. I am Olumide Abimbola. Our producer is Shola Lawal, with assistance from Hannah Lang in Berlin and Paulette Mboga in Nairobi. In the next episode, we ask, why are African musicians not so happy with the music streaming platforms taking their songs global?